Welcome everyone to SDR Ventures and 5 key factors impacting the sale of your business in 2024. We genuinely appreciate everyone's time. We anticipate the webinar running 20 minutes and we'll encourage Q&A at the end. My name is Jeff Eliason. I serve as CEO of SDR, a lower middle market investment bank headquartered in Denver that's been around for 22 years now, serving founders, entrepreneurs, business owners, most often as they set out to sell their company. I'm joined by Scott Mitchell. Scott and I collectively lead the team at SDR, Scott serving as a managing director, and it's a real pleasure for both Scott and I to serve founders, entrepreneurs, and the entire ecosystem that serves that network of business owners. So Scott, let's go ahead and kick things off with 5 key factors impacting the sale of a business here in 2024.
Absolutely. Well, Jeff, let me ask you the first question really is, with hindsight on 2023 M&A activity, what do you take away?
Well, 2023 was a time that was made up of about an 8-month pause. So we headed into the new year this time last year with a tremendous amount of momentum coming out of 2021 and 2022 as far as M&A activity. And then the Fed made a very dramatic increase in rates over a very short period of time. And both sellers of companies and also investors, professional investors, those that buy businesses, collectively hit the pause button and decided to put their pencils down until they had their arms around what the Fed was doing, when inflation was going to peak and turn over, and ultimately get an understanding of when the Fed would stop raising rates and potentially begin decreasing in interest rates. And so we have witnessed that happening. Inflation has started to go down, and the Fed is signaling a decrease in rates. And almost overnight, it wasn't the ice thawing. It completely melted, and M&A, all of the pent-up demand for M&A activity that was building up over those 8 months in 23 has now been unleashed in 2024. And so we've got a great time for both buyers and sellers as we head into the new year. As we go to the next slide, Scott, we're heading into this new year, some uncertainty. What should business owners and their advisors be on the lookout for?
Yeah, absolutely. And given the our commitment to a 20-minute webinar, this is very much going to be the Cliff Notes version. But we really did want to address kind of 5 macro factors that we felt like are really key throughout 2024 that is going to impact macro conditions for M&A. So we'll go through them one by one. The first is recession dynamics, soft landing, hard landing. What are economists saying? We'll look at that. That really dovetails into looking at customer end markets. Investors right now very focused on the types of customers that a business has. And maybe not even your direct customers, well, certainly your direct customers, but also your customers, that source of funding. And then third, we'll look at the credit markets. What is the Fed going to do? What's impacting banks? Then we'll talk about this a little election that's coming up in November. Some of you may have heard about that. We'll talk about what the fallout looks like from who ends up in the White House. And then lastly, we'll look at private equity dry powder. And dry powder is just a way of saying the amount of money that private equity has raised that it needs to put to work in deals.
Scott, most economists, if not all economists, seems to have predicted a recession in 2023, and that was the recession that never happened. What are you expecting and anticipating in 24?
And one of my favorite lines is most economists have successfully predicted 10 of the last 5 recessions. So just, take that with a grain of salt, right? And some of it's really about sentiment in the market. Sentiment was really down last year among consumers because they were hearing all the signs of recession, right? So as we kick off 2024, there is a lot more optimism around that soft landing, that's achievable. And in fact, probably that's where most economists' heads are at right now. That being said, one of the groups that we follow closely, ITR Economics, the Bolio brothers, as we look at their data, and I'm not going to go through all of it, but there's some red up there, right, in terms of 2024 growth. So they would actually be saying, hey, there probably is still the recession around the corner. So, I think either way, right, soft landing might be the best case scenario, and then a mild recession is sort of the worst case scenario. The soft recession is we kind of land the plane, glide down and hit the runway smooth. Hard recession, right? Hard landing is a screaming fireball into the runway. And then, the mild recession is, there's some pain, there's some bumps along the way, but it's not super severe. And so the difference really between what would happen in a deep recession versus a mild recession or a soft landing is in a deep recession, you've got some universal pain, right? Your whole body hurts. In a more soft landing or mild recession, there is some pain, right? But it'll be more localized. You'll have to look at industry, sector, and various situations.
So Scott, let's get practical. Say it's a soft landing or a mild recession. What does that mean for the founder or entrepreneur that's thinking about the impact on how a buyer or an investor views their business?
Yeah, absolutely. So it really starts with the question, is the potential for negative growth going to shrink the size of your market or your industry, right? And you have to start with your own customers, and then you have to peel back the layers of the onion a little bit to look at their source of funding and their customers. I use a very simple jewelry store analogy where, if consumer balance sheets are challenged, and spending is shrinking, and they may not be buying as much really expensive jewelry, right? So that impacts the jewelry store owner. You say, great, I'm not a jewelry store owner. I'm a distribution company. Okay, well, what do you do in distribution? Well, I distribute jewelry boxes to jewelry stores. Okay, well, you kind of look at that and you say, you know what, some of those same impacts that are happening to the customers of the jewelry store are also going to impact me. Another thing that we're monitoring very closely is, if you're tied in with the real estate industry. Wall Street Journal recently published an article, 30-year low in housing sales. Again, largely tied to interest rates. If you're tied into that economy, right, of real estate transactions or new home construction, it could be challenging, right, if you're in the mortgage industry or things of that nature. So, those are some industries, examples of where investors are hesitant. The good news is, in kind of that soft landing, mild recession, if they operate on a pendulum, right, and so they still want to do deals, they just want to be smart, and they're going to operate on a pendulum, rotating away maybe from some of those riskier industries and toward things that they deem safer, right? Less likely to shrink. So, healthcare services is a great example, right? Where ultimately the funding coming from Medicare, Medicaid, or insurance companies means there's a lot more safety. Aerospace and defense, pretty stable when you have the government doing a lot of the spending. We know that, and we saw it last year with the Inflation Reduction Act. If there's challenges in the economy, the administration often tries to pump that up with spending on infrastructure maintenance and things of that nature, shovel-ready projects. So you really do have to drill down and peel back the layers of the onion to see how investors might be thinking about your industry.
Scott, continuing with a desire to be extremely practical to our audience, we know that credit is really the grease that makes the private equity wheels go. Lending, credit. What do you think is going to happen with the credit markets, especially with the backdrop of 2023? What are you seeing in 24? And what does that mean for founders and entrepreneurs?
Well, as you mentioned, Jeff, in recent polling from a significant number of economists, the median forecast has 2024 rates coming down from the peak we're at now, potentially, to 4.25%, 4.5%, right? If there's 3 cuts, maybe even in the last couple of days, some signaling that, okay, maybe those cuts happen a little bit later in the year, maybe only 4.75%, right? The exact level, I don't think is actually as important as just the simple trajectory of the rates coming down. The trajectory is maybe more important than where they land. And we overall see the momentum and the progress of rates coming down as being a huge net positive on deal activity. One thing that was really challenging for banks last year, and the reason they were reluctant to finance deals, is they were really struggling with their deposits. In order for banks to put money to work, they have to have money to lend, right? Last year in September, it came out that U.S. banks reported a drop in deposits of nearly $900 billion. So we're really watching those deposit levels entering 2024. We're anxious for that first available data on deposit growth. Even mild growth would be a significant positive signal for 2024 M&A activity. And then last year, right, a major challenge for commercial banks is exposure to the office market. Many banks are heavily invested in office real estate. So, if vacancy is peaking around 20% this year, we know that 11% of leased office space in the U.S. is set to expire in 2024. This is, for banks that are heavily invested there, if tenants aren't re-upping on their leases, that could have a major write-off impact on that asset class for commercial banks. So again, something we're very cognizant of.
Great insight, Scott. Well, the slide that probably everyone's been waiting for, what feels like the $1 million question. We've been receiving so many inbound inquiries from business owners asking about the impact of the presidential election on M&A, the value of their company. Scott, what do you think? Is it the $1 million question, and what's the impact?
Yeah, absolutely. Well, we're not going to predict the future here. I would say the last 2 election cycles, we saw deal volumes and prices rise the year after, the Trump election and the Biden election. After the Trump election in 2016, the sentiment toward a pro-business administration helped M&A. But actually, an even greater help to M&A was the fear of cap gains taxes increasing in 2021 after Biden won the election. And so that was a massive motivator for folks. And so certainly that's not to say that these two data points signal an increase in deal activity no matter what happens this year. But I will say that public sentiment around the next administration is a powerful force that often does have an impact on deal activity. The other thing I would say is that, you know, the impact of the 2024 election, given it's November, will probably not be really felt until 2025.
Interesting. This next slide could be really informative for business owners, founders, and entrepreneurs. Oftentimes, the buyer of their company is a private equity company that may have a private equity fund. We should all be aware of how those firms and funds are set up and how their capital is deployed and how they deliver returns to their investors. Scott, with that being said, as the backdrop, how does that reality impact deal flow in 2024?
Absolutely. And I would say that the amount of private equity dry powder out there is by far and away the strongest indicator pointing to a rise in 2024 deal volumes and valuations. PE deal volume and deployment, as we already talked about, was down significantly last year. If private equity managers sat on the sideline and didn't invest, their investors are likely getting impatient. And so oftentimes they have contractual obligations to deploy those funds or in certain timeframes, or they have to risk returning that money to the investors. And so we believe that there will be significant pressure to put assets to work this year. And that strong demand pressure should be a significant positive for founders and entrepreneurs. So Jeff, I'll throw it back to you. We've talked a lot about these macro trends, but you know, a good rule of thumb I heard is that business owners should spend only 10 to 20% of their time thinking about macro factors they can't control, and the remaining 80 to 90% on those they can. And so what critical factors that are core to their businesses are most important that investors are looking for?
Yeah, we call it the usual suspects, and there's 7 areas that business owners, founders of companies can really focus on that from a buyer's perspective drive the value of an acquisition. And these 7 factors really separate an A-class asset from a B-class asset. I don't want to read through all 7 factors, and you know, our team is always open to talking with you and evaluating an exit readiness assessment. But I do want to emphasize just a few that really should stand out. Investors are buying what existing cash flow has been, but they're also buying potential. So they want to see strong growth potential coming from cash flow, revenue, EBITDA, net income, EBITDA margins. Buyers want to see recurring or reoccurring revenue. And I mentioned cash flows, consistent cash flows, especially as we've had some time coming out of COVID. And most also important to a buyer, as we see some recessionary pressures coming in 2024, the more a business can demonstrate historically a resistance to those recessionary dynamics, the better. And again, open invitation to the audience to have
Whoops, I think Jeff froze there. Hopefully we'll get him back here quickly. But that's really as far as the 20 minutes that we wanted to provide to people, we do have a Q&A feature on the webinar. So if you have time to stick around and do a little bit of Q&A, or we'll answer some questions here. Alternatively, if we aren't able to get to all of the Q&A, we will we'll follow up in email, and we will make this presentation available to anyone that is on the webinar. So, Jeff, I don't want to put words in your mouth, but I think what you were starting to say is that really it starts with preparation, right? And doing the work on the front end to sort of get ready for approaching the capital markets, whether you're selling, buying, or raising money. And so, we're here to help.
Absolutely.
Becky, do we have any Q&A if people are able to hang on?
We don't have anything that's come through yet. So I think you guys did a great job just kind of addressing everything. It looks like Peter is raising his hand. Let me see if Peter, if I can get you off mute. Okay, Peter, I think you're unmuted now.
Okay, I think that worked. Hey guys, thanks for the webinar. Just a couple questions on M&A trends. Curious on your thoughts on sort of two different angles here. Number one, tack on versus call it non-tack on M&A activity. Where do you see the trends going with respect to those two? And then any thoughts on sector specific activity, right? Scott, I think you mentioned healthcare. Do you expect healthcare to pick up and industrials to lag? Anyway, I'll leave it there and get your thoughts.
Yeah, absolutely. You called it tack on, right? The other term we hear often, right, is a bolt on or an add-on, right? To pick your flavor. And what that really means is that the private equity group has already bought a company, and then they're bolting on or adding on companies, to that existing portfolio company. 2023, a lot of the deals that did happen were those bolt-ons, those add-ons, right? In some circles, I heard 2023 called the year of the add-on. So I think the reality is, in order for private equity to deploy the amount of money they need to deploy, they've got to do more platform deals, right? Sometimes you run out of add-ons, or they tend to be smaller and things of that nature. And so, you do need those strong platforms, and you can't bolt stuff onto something if you don't have a platform, right? So you got to do some more of those deals this year. And really what drove the challenges last year were the financing challenges of getting a platform financed. So early in the year, until we see those rates start to come down, I think, add-ons will still be, probably the most significant component. And then as rates start to come down, hopefully we see more platforms. Just as far as the industry stuff, right? I think, it's really dependent on kind of how strong the characteristics are in the funding, at a macro level, for that particular industry. We're working with some companies right now that they manufacture food, right? For instance, so it could even be as you have to get as granular as, well, am I manufacturing food for really high end, the Whole Foods of the world, right? Where, whole paycheck, right? Or am I doing consumer staple type products, right? Where, if their balance sheet shrink a little bit, that it's, you know, more likely to start buying canned green beans, right? So you even have to sort of drill in at that level.
Becky,
Got it. Thanks, guys.
question came through, and I know you answered it, but I'll answer it for the audience. And that is, what size of company does SDR work with? And we will work with companies that range in one division that focuses on companies with an EBITDA between 500,000 and 2 million. And then another division that focuses solely on companies with earnings or EBITDA north of 2 million. And so that really runs a wide range from enterprise value of 5 million up to 250 million as the lower market is oftentimes defined. Becky, do we have any other questions as we round it out? I know if we can be a resource to the audience, our contact info is on this slide. Are there any other final questions?
Nope, that was it. But as always, feel free to reach out with any questions. I will be sending out the recording of this, but thank you so much for joining, everyone.
Thank you.
Thanks, guys.